All right. The wheel.
The wheel, the Liz and Jenny special. The wheel is a strategy used to obtain 100 shares of stock at a lower basis than the current market price. You do this via a short put, which is then converted to a covered call. So the act of selling the put, ideally that the stock stays range bound or goes slightly lower, you take stock, and then once you have the stock, you could sell calls as a covered call position against it. It's a way to collect premium on both sides of the market while also taking intrinsic value and getting that stock position, collecting dividends, all that stuff comes along with it as well. I think generally we talk about it more of a longer term strategy, but it can be done in a shorter duration. So typically we talk about it on like a 30 to 60 day time frame, our normal trading time frame. But a lot of people use this as a way to get a quick reduction in cost basis, right? You could look at this from a weekly time frame or a 2-week time frame. Let's say you want to get into the stock at the end of the week, but you don't want to buy it here today up, $2. Let's say you're looking at the segment, kind of the idea came from a Rivian email that I got. And basically the guy said, hey, I don't want to buy the stock right now, but I want to get long it, into the next couple weeks. Maybe you sell an at the money put in this weekly or next weekly expiration where you're selling at, $1 or $2 at 5 or 10% basis reduction. It allows you to take the stock right here if we go slightly lower. You don't have to buy at the highs, so to speak. So you can definitely use the wheel strategy in that context of, hey, I don't want to buy right now because the stock's up 3%, but I do want to own it next week or 2 weeks from now, or participate in the upside if it does continue higher by selling that put and potentially taking the stock at a lower basis there. As we said, you collect premium on both sides. So if you were selling the put, you sell the put for $1, you collect that premium. If the stock goes down, your basis is $1 lower than your strike price. You then sell calls after you take the stock. Let's say you sell the call for another $1. Your total position has reduced basis on the stock shares by $2 based on those two premium positions that you sell to get into the position. Of course, it benefits from an up or sideways movement. So you do give up the right tail, that upside infinite profit potential, because if you're selling the put, you have a capped amount of premium and a capped amount of value you can capture from that position. Same thing with the covered call. If you sell the call, you can only profit up to a certain point. So there is a caveat to this trade. You don't get that unlimited profit potential to the upside, but it does give you ways to profit from sideways, a little bit of a down move, a little bit of an up move. You can definitely be better off with a short put versus a call or a long stock position, vice versa with the cover call. Selling the call and the stock stays sideways, it's going to benefit you more than if you were just long the stock.
Yep. And the nice thing about this strategy is, yes, you can acquire the 100 shares of stock if you want to get the dividend, long-term taxation, et cetera, et cetera. But if you're in a product that doesn't have dividends, or you have more of a short-term outlook on what your position wants to be, you can really just roll the short put forward too, because an in-the-money short put is the same thing as a covered call. So lots of ways to kind of achieve the same thing, but traditionally the wheel is taking the shares and then selling that covered call against it.
Yeah, it's a good intro strategy for somebody trading in an IRA account or something like that that's a little more risk averse and wants to be in shares but kind of wants to do it a little bit more efficiently. This is a sort of strategy that I would put them on. So here's a visual of what we're talking about here. So selling the put and then wheeling into the stock. Wheeling just refers to taking the stock if the put goes in the money. So let's say the stock's at 100, you sell the 92 strike put at $2. Gives you a break even at 90. If the stock goes down, it can go down past 90, but let's say it goes down to 90. You'd take the shares, you'd be flat on that position. Your basis is 90, the stock's trading at 90. If you were just buying the shares at 100, You take that heat all the way down to 90, you're down $1,000 on this position. Of course, had the stock gone up $10, you'd only make $2 on the put versus $10 on owning the shares. But this is a much bigger swing in P&L versus both being on the profiting side. And so I think that's why people like this strategy and use this strategy a lot, is because it certainly reduces your P&L volatility on the position because you have capped upside and a lesser downside versus shares.
Yep, and it's always interesting when you talk to people about this strategy and explain what it is, and it's like, well, if my intention is to get 100 shares anyways, why wouldn't I just do this and give myself more of a conservative approach to getting those shares and a much higher probability of success? Because even if the stock does go up, you're still making money. You just you don't make that tail profitability, but more often than not, the stock's not going to rip higher every time you buy shares. It's probably going to stay the same, maybe go down a little bit, maybe go up. So if it's inside the expected move, you're likely making more money with this, or at least protecting yourself against downside moves like we're showing here.
Yep, for sure. All right, so after you've taken the stock, so you're going from a short put to a cover call position. So again, we took stock at 90. We went and then sold, just for this example, we sold the 100 strike call against it. We sold it for $1. It adds to your profit potential because you're adding a decay component, adding extrinsic value. You'll be even more better off versus stock if the stock stays below 100, because that call would lose value. It's extra reduction to the total basis on the position. But net, you take the stock at 90, you sell the call at $1, or you take the stock at 92, you have a basis of 90, you sell another $1 worth of extrinsic value, that further reduces your basis. And if the stock comes back to 100 versus just being long the stock, of course, you'd be flat on the stock position. You bought it at 100. It's trading at 100. With the short put that you wheeled in, and whatever this time frame is, you're up $1,100 versus the stock position that is flat. So you've benefited from not only the movements back and forth over that period of time, but also adding an extrinsic value component, which furthers that upside. Even if you had timed it and bought the shares at 90, the same basis, or 92, if the stock got to 92, you'd be better off with the short premium, because the short premium is another $3 of value that you've captured in this time frame, whether it's 30 days, 60 days, or if you're selling weekly puts, you're net better off just selling the puts and not having to rely on timing the stock going to 90.
Yep. And that's the beauty of this strategy, is that, yes, you sell the put, you do have downside risk, but you have no intrinsic value risk until it breaches 92. And at expiration, because you've collected $2, your break even is below 92. So you have a lot of wiggle room to the downside. And this is actually why I have said many times, like, if I were to do one strategy only, if I were to be forced to pick one strategy only for the rest of my life, it would probably be something like this: the wheel or short put in S&P products or the Qs, because there is almost always aggressive put skew, which means you're just getting paid a lot more to take downside risk. You can move that strike further out of the money, and eventually, if you're fine with taking 100 shares of risk there, and you're okay with the assumption that eventually the market will climb back up, it can be a really nice conservative strategy. So,
yeah,
love to see it.
The biggest caveat is you miss out on that infinite upside potential. And that's the one thing to remember. Anytime you have something that's on the better side, right? So you're going to have a lower break even, less risk on the downside, same directional exposure to some extent, but you're giving up that infinite upside potential. So that basis reduction to the downside caps your upside profit potential on both sides of this trade. On the naked put and the covered call, you're capping that right tail, that infinite upside potential.